All right. Today is Sunday, August 7th. This is a recap for the stock market activities last week and an outlook for the week to come. And folks, I got a good one for you tonight. Before we start, two notes. Note number one, the old microphone fell down and broke, so that's gone now. Rest in peace. So I have a new mic, and we're having a hard time here getting to the sweet spot. A lot of viewers say that the volume is too low. A lot of folks say it's too bassy, whatever. So I hope that this is the sweet spot. Let me know if you can hear me loud and clear. No problems at all. Note number two, you might have noticed the return of the arrogance in the stock market. From reading the comments in this channel and the commentary in the news media, it is really helpful to get the feedback that the arrogance is back in the stock market. A lot of folks are saying, oh, Michael Burry, really, he's a broken clock. The same guy who got it right twice in the dot-com bubble and the housing bubble. He's a broken clock now. Oh, you don't understand, Maverick. The trend is your friend. We're back. The Fed will never make good on their promises. Higher we go. You don't understand. And it's really helpful to get the feedback from the viewers because it is a sentiment indicator to me. And what I see right now is the return of arrogance, extreme arrogance, the like that we've seen in 2020 and 2021. Now, the good news is the arrogance will be washed out of the stock market once again in the most brutal and violent fashion because the Fed is not going to pivot. And the data that we got on Friday proved that point exactly. And I remind you of this. Here was the chart of the Qs, the NASDAQ, and since December 7th, the chart went down from that point on all the way by about 32%. And guess who told you back in December 7th that this is a bull trap, an epic bull trap in the making? The answer is the guy you're listening to right now. And the thumbnail of that video was Jerome Powell asking you, so you want to fight me? You want to fight the Fed? You think that's a brilliant strategy? You think you're going to win fighting the Fed? Certainly the bears learned their lesson not to fight the Fed the hard way when the market was being pumped artificially by the Fed higher. And now the bulls, we thought they learned their lesson not to fight the Fed, but apparently not. And they're not really the bulls. The bulls always make money. It's the sheepies. The sheepies still doubt the Fed. They still say the Fed will never do it. The Fed will actually cut interest rates. I will expose to you all of that delusion using the facts and the data and why Jerome Powell will slaughter the sheepies once again. Without further ado, here it is. In focus tonight. Round number two. You want to fight Jerome Powell? He's going to crush your little head once again. Why do we say that? Because we got the jobs report on Friday and it came out hot, hot, hot. Well, wait a minute, Maverick. What are you upset about? The jobs number indicates that the economy is doing beautiful. Why is this bad news? Hold your horses on that one, but here are the facts. The economy, if you believe the data, hypothetically speaking, created over 500,000 jobs in July. We know that the Bureau of Labor Statistics cooks the numbers all the time, specifically before an important election season. And they did that, by the way, with previous administrations, so there is no different here. But hypothetically speaking, let's say that we take these numbers as factual. Wait for the revisions, by the way. But anyways, let's say that the economy indeed created over 500,000 jobs in July. Here's the good news, specifically for the Joey B administration. Now they can say, without lying of course, that they have recovered the entire job losses since the thing started to appear in 2020. Not created, they did not create not a single job, but they have recovered the entire loss since the thing began. Another piece of good news, we're seeing more participation by females in the economy, getting more jobs, while the participation of men is actually going down. So to the ladies out there, welcome to corporate slavery. This is what you wanted, right? And according to the report, the majority of jobs created, or shall we say recovered, were actually in the leisure and hospitality sector of the economy, which created about 96,000 jobs in July, followed by professional and business services, which created about 89,000 jobs. And then we have government, which created about 57,000 jobs. I guess all of those are IRS agents who are about to harass you and audit your tax returns. But as you can see, on face value, it's a pretty decent report. It's pretty good. Jobs created across all sectors of the economy. Yes, we're seeing more in leisure and hospitality. That is, of course, in response to the summer traveling season. Airlines are complaining of shortage of staff. Cruises, the same problem, and therefore they're hiring more employees. Now, here's the bad news. The stock market, at least in the futures, the pre-market, went down sharply in response to the jobs number. Why? Why would the stock market goes down on good news? I thought the risk was we have a recession and the economy is about to implode, but now we have a really strong jobs number. What is the problem here? Why is the stock market upset? The answer is good news equals bad news equals good news. Why? Because it's all about the cocaine, baby. It's all about the Fed's cocaine. Bad news means that the Fed doesn't have to increase interest rates as aggressively as we thought before. Good news means that the Fed has the permission to increase interest rates as aggressive as they can to tackle inflation down. And hence, good news equals bad news equals good news. Now, the assumption by market participants so far was that the Fed will actually pivot because enough damage has been going on in the economy. The Fed will pivot from increasing interest rates in September to perhaps starting to cut rates. That is absolute delusion, specifically when you look at the data. The bad news, good news for workers, but not really, because the majority of wage inflation is being eaten away by the rise in inflation. But look at wage inflation across all sectors of the economy. Wages are going higher. What does that mean? Inflation will go higher. And here's another alarming sign. Look at the wage increase in the leisure and hospitality sector of the economy. Unbelievable increase. What does that mean? It means that these employers in the travel and leisure, airlines, cruises, whatever, they're hiring folks right now because they have to, because the demand is too high. So they're hiring people regardless of wages. They're paying an arm and a leg for these wages. All of these jobs are being created under inflationary wages, also known as unsustainable jobs. Why do I say that? The financials of these companies, airlines and cruises, hotels, they're not really that good. So now they need staff, and they will pay whatever they need to pay to respond to the summer demand season. But once that's gone, because the economy is weakening or because the summer season is over, these companies will realize that they're overstaffed, but most importantly, they're overpaying for some employees, and they have to get rid of these jobs. And therefore, as an economist, I don't put any weight at all when it comes to the employment report and how it factors in the upcoming recession or not. The recession will happen because, as I said in a tweet today, unemployment is the symptom of a recession, not the cause. So when people say, oh, how do you say that we're going to have a recession down the horizon when the economy is creating, quote unquote, over 500,000 jobs at this point? Unemployment will rise higher when the recession happens, not before. It's not the cause. And I will explain that to you in details using the data in a minute. But before we do that, here's the bit about wage inflation, why it keeps the Fed in the tightening camp, the aggressive tightening camp for now, and the pivot crowd is proven wrong because wage inflation means more inflation in the pipelines. This is not just me saying that. Even Pumper, professional Pumper, the biggest misinformer in economic history, Jason Furman, even he says that. And every time I agree with Jason Furman, I'm like, wait a minute here. Am I doing something wrong by agreeing with this guy? But maybe he's right. Maybe Jason Furman is the real broken clock, not Michael Burry. Well, Professor Furman says, uncomfortably hot jobs report, 528,000 jobs added, and unemployment rate falls to 3.5%. What worries me, re-inflation, is average hourly earnings were up at 5.8% in July. Listen to this. June was revised to 5.4%, up from 3.8%. The wage moderation we were all discussing last month was simply wrong data. Furman adds, overall, I've thought the consensus was over-worried about a recession and under-worried about inflation. This report is consistent with that. It is nice to see many jobs added, but it is scary about what it means for the size of the adjustment we may have coming. Not the sweet spot, Furman says. And I say this. Perhaps this is easier to understand than Professor Furman. I said the economy created over 500,000 jobs in July. Translation, Jay Powell will whack your little head. Interest rate cuts, you say, ? The pivot crowd has been proven wrong. There is no pivot. The Fed now actually has the perfect excuse to go even more aggressive in raising interest rates in September. Even Fed zombie Bowman came out and said that she sees a similarly sized rate hike in the next meeting, meaning the 75 basis points, if not even more. Mohamed El-Arian says that the Fed will have to break this economy to tame inflation after the strong jobs report. The Fed is not pivoting, and the sooner you realize that, the better. Otherwise, you're gonna get crushed. And listen to Larry Summers, what he said. We're not even close to the neutral rate, but most importantly, listen to what he says about core inflation versus headline inflation, which is the theory that I've been floating for a while now. That we will see headline inflation down, but core inflation sticking, if not even moving higher. And the most important event we have next week is the CPI. So here's Larry Summers. Take a look.
So what message does this send to the Fed, do you think? Look, I don't think the Fed has the thread right now. As I said on this show last week, I think the idea that we're at the neutral rate or near the neutral rate is not a defensible concept. And now when we're seeing wage inflation unambiguously after this number, accelerating after this number, after the ECI, after the Atlanta Fed, we have, by every reasonable measure of core inflation, inflation running somewhere plus or minus 5%. That is more than it was when Richard Nixon put price controls in place. That is not acceptable by any dimension. And if we don't act on it and act strongly on it, and that means raising real interest rates significantly, then we're just setting the stage for stagflation. Here's what I'm very worried about, because we've seen the movie before. I'm worried, and I was interested to see that Paul Krugman, who's hardly agreed with me in general on these things, expressed exactly this concern today. I'm worried that we're going to see some good news on non-core inflation, on commodities, on what's happened in gasoline, for example, and we're going to see a bit of economic slowing, and that's going to lead the Fed to think that things are under control. But in fact, underlying inflation is going to be still completely unacceptable. Things are going to go up and down in terms of the non-core inflation. And if we've got a labor market that's red hot, that's only going to mean constant or even accelerating inflation. And we're going to have a situation like we did in the 1970s, where we perpetuated inflation by not doing enough to contain it. The doctor tells you to take all your medicine. If you take only some of your medicine, you're going to get the illness back.
And of course, here's the problem with the pivot crowd. The pivot crowd will now become the soft landing crowd. You'll hear them come out today, meaning Friday, saying that the Fed still doesn't have to raise rates, even though the jobs number is hot, because commodities are down. Somebody please tell them there is something called aggregate demand. When prices go down, yet people are flush with cash and they're borrowing like crazy, using credit cards, that aggregate demand will kick in and keep inflation high, number one. Number two, while commodities are down, this will impact headline inflation, not core inflation. Core inflation will remain hot. And the worst possible scenario for the bulls is if we see a weaker jobs number, really weak, but we see inflation moving higher. The second worst case scenario is if we see the jobs number moving higher, like we got on Friday, yet inflation sticks or even moves higher, at least the core CPI. That would be a bad outcome because it means that the Fed has to be more aggressive in tightening the monetary policy. And here's a reminder for you. If you say that commodities are going down, we have peak inflation, it's done, the Fed doesn't have to complete the course. Reminder, back in the 1970s, inflation kept coming back with more vigor. Even after periods of decline, the Fed never solved the underlying problem. Any suggestion that the Fed should pivot now and stop increasing rates will ensure that inflation will be built back better. Forget about the so-called Inflation Reduction Act. That is a cover to steal taxpayer money. This will be built back better. And there is yet another alarming sign from the jobs number that we got on Friday. On face value, good news. The economy created over 500,000 jobs. The bad news is wage inflation. But number two, look at the labor force participation rate. It is absolutely collapsing. It has never recovered the drop since 2020. So how do we explain that the economy is creating over 500,000 jobs, yet the labor force participation is actually moving down? Perhaps this? The headline from the Washington Post reads, "Workers are picking up extra jobs just to pay for gas and food." Whoops. What if the so-called jobs created is just employees taking more jobs? That would actually be a really bad outcome for the economy and the stock market, because the Fed will read the headline number, the economy created over 500,000 jobs, and that merits them increasing interest rates even more aggressively by 75 basis points, if not even more, in September. But what if the devil in the details say the economy is actually a lot weaker than we expect, despite the jobs number, because the majority of these jobs created, quote unquote, are actually employees taking more jobs, second job, a third job to pay the bills, because inflation is killing them. Now imagine the Fed tightening under these conditions. That's a double whammy in the economy, and a certainly double whammy in the stock market. When we talk about the scenarios and the dual mandate of the Fed, employment and inflation, price stability. Here's something that I thought about over the weekend, and I did not put a lot of thought into it, so if you say, hey, Maverick, this is so lame, who cares?
I'm not that clever.
I think the point is clear. This is a meter of severity. If we get a really hot reading in jobs or inflation, you're going to get the flame emoji. If it is stronger than the estimate, we get the strong emoji. If it is exactly at the estimate or close in variation, we get the plain vanilla emoji. If it is a lot weaker than the estimate, we get the, well, weak emoji, whatever that is, logo, I don't care what it is. It says weak. I think the message is clear. And then if it is way below estimate, such as a disastrous number, we get the nuke emoji. Is this clear? If it's not, that's your problem. Anyways, when we look at the hyperinflation scenario, in this scenario, we see a really hot jobs number and a really hot inflation report. In a hyperinflation case, the economy would create about 1 million jobs at this point, fueling wage inflation. We see the CPI blasting above 10%. This is not where we're at right now. When we talk about inflation, if inflation is still persisting, we get a strong jobs number and a strong inflation number. On the other hand, if we have stagflation in the economy, we get a weak jobs number, but inflation remains strong. In a recession scenario, both jobs and inflation get nuked. In a soft landing scenario, we get a weak / plain vanilla jobs number, not a lot of job losses, unemployment climbs slightly to about 4 to 4.5%, but we get weak inflation readings. Now, there are possible scenarios in between, but these are transitional scenarios. If, for example, the jobs number comes out plain vanilla and then the inflation reading comes out also plain vanilla, this is a transitional period for the next economic phenomenon. They're going to settle at either one of these scenarios right here. So for now, what did we get on Friday? We got a strong employment report, and therefore we're now waiting for inflation. The CPI comes out next Wednesday, and the assumption for now is we will see a strong inflation report. Yes, headline down, but core inflation is going to stick. Now, the bulls are hoping for a weak inflation report, meaning not just the headline is down big, but also core is down big. And that gets us closer to the soft landing scenario, which is a fantasy, by the way, but I'm just explaining to you all of these scenarios and how they will play out. In the first possible 3 scenarios, highlighted in the green box, these are the scenarios where the Fed is going to continue to increase interest rates higher. Hyperinflation, which is not foreseeable for now, inflation and stagflation. In the red box, rectangle or whatever, the Fed cuts interest rates, and these scenarios are the soft landing or a recession. For now, it appears that we don't have any of these scenarios, the recession or the soft landing, and therefore the pivot crowd who says that the Fed will cut interest rates are wrong, at least for now. Now, let's talk about recession. Does this number, the employment report that we got on Friday, cancels the recession? I already told you no, but I'm going to prove it to you. But before we do that, let's listen to a gangster from JP Morgan, the landromat, Jamie Dimon. Take a look.
Right now, the American economy is kind of strong. And a recession, the technical terms of recession, of shrinking GDP, I'm not sure I even believe those numbers, by the way, because they're so distorted coming out of COVID, supply chains. Unemployment is still going up. I don't think I've ever seen a recession where employment was getting stronger, not weaker. Jobs are plentiful, wages are going up, so people have more money, they're spending more money, they have more money than they had pre-COVID. They're spending 10% more than last year, 35% more than pre-COVID. That doesn't sound like a recession to me currently.
Now, Mr. Dimon says, by the way, he said that we're about to see a hurricane. Remember Mr. Hurricane? Now he says, I don't see a problem at all. Of course, he's going to talk his book as we get to the election season, because this administration has been the best administration to corporate America in history. Billions and billions of dollars in handouts on corporate socialism. Of course, the corporate leaders will come out of the woodworks defending this administration. But Dimon says the consumer is still spending. Consumer spending is moving higher. They're doing great. What he's not telling you is consumer spending is going higher because of the dollar amount. It's not because they're buying more. It's because they're spending more. Why are they spending more? Because of inflation. They're spending more at the gas pump, the grocery store, utility bills, etc., etc. This is not good consumer spending. This is bad consumer spending because it is fueled by the rise in inflation. But Demon also says that he does not see a recession right now because we have a hot employment number and we have wages moving higher. Everybody's doing good. Here's some history lesson for Demon and the rest of the pivot crowd. I don't know why he's pivoting right now, but here it is. These are the job losses before and after a recession. In this chart, as you can see, the shaded areas in gray are the periods of a recession. And the chart in black, when it climbs higher, that means job losses in the economy. But notice what happens before the recession. We see severe drop in job losses. We see job creation. And then in most cases, job losses only start as the economy already dips into a recession or gets really close to it. So when the pumpers talk about the jobs number as canceling the recession, they have absolutely no clue what they're talking about. They're taking a lagging indicator and they're making assumptions based on that. Once again, jobs losses, unemployment is a symptom of a recession, not the cause. Likewise, here's another chart for you regarding wage inflation. As you can see again in this chart, the areas shaded in gray are the periods of recession. And before that, we see significant increase in wages. And then wages drop big time during a recession. So again, when people talk about, oh, but wages are moving higher, Maverick, you can't have a recession when wages are moving higher. And we have excellent labor conditions. That always happens before a recession. Perhaps a more reliable indicator for an upcoming recession is the inversion of the yield curve. And as you can see, once again in this chart, recession is shaded in gray. Every single time we have a recession, the yield curve inverts before that. What is the yield curve looks like right now? Here it is, the worst inversion in 2 decades. So if you think that the recession has been averted because of one hot employment report, you're sadly mistaken. On top of that, we talked about how the majority of jobs created, quote unquote, in the economy are in the leisure and hospitality sector of the economy. We talked about what happens after the summer demand season is gone. They will get rid of the majority of these jobs. But here's more evidence for you. Remember when we talked about the recession and different classes? Right now, the poor and the lower middle class are indeed in a recession, but not yet in the middle class, the upper middle class, the rich, the oligarchs. But the recession is working its way higher. And sooner or later, it's going to hit these demographics too. The folks who are traveling right now and taking trips and booking hotels and Airbnb, they're not certainly from the poor or the lower middle class or even the middle class. They happen to be from the upper middle class and the rich. Little by little, when the recession climbs higher, it's going to hit that particular demand. And therefore, we will see all of these travel companies getting rid of all of these jobs. So fast. I promise you, folks, mark my words, you will see these travel, leisure, and hospitality jobs being lost so fast, you're not going to even believe what happened. And the evidence for that is, look at what's going on in the automobile market, for example. The headline reads, car makers start to see weaker demand amid inflation squeeze. What does that mean? Here it is. Car makers are reporting lower demand in Europe and North America amid what analysts say is growing evidence that consumers are balking at higher prices and keeping their cash for necessities. But listen to this. This is the most important piece. Although some upmarket brands like Ferrari and Mercedes have raised sales forecasts due to continued high demand for top-end models, the outlook for the bulk of the industry is bleaker. Ladies and gentlemen, this proves my theory that we're seeing the recession hitting the lower middle class, some element of the middle class, and it's creeping its way higher. It has yet to hit the rich, the upper middle class, and therefore we're seeing sales in brands like Ferrari and Mercedes not being impacted, at least for now. But that's coming. More evidence to support this theory. Listen to this headline. U.S. consumer borrowing jumps by more than $40 billion, the second most ever. Look at this. The consumer is borrowing more. If we have a hot economy and everybody's flush with cash and there is no recession coming, then why is the consumer resorting to using credit cards and taking more debt to cope with the cost of living? And that, by the way, solidifies the theory that a lot of these jobs that are created, quote unquote, in the economy are actually folks taking second or third jobs to cope with the cost of living crisis. More economists are now calling for a recession. The recession probability rises to 40%. And when the economists say 40%, it's actually 100%. Yet the stock market remains in delusion. Stock market participants, specifically the sheepies and the gamblers, they're not absorbing any of that. They think that the data actually doesn't matter. What matters is the Fed is going to cut interest rates. And since June, they have actually priced in 3 interest rate cuts, not hikes. Cuts. You wonder why we have the June bottom for now? You wonder why the stock market has been blasting higher since the so-called June bottom? This is 100% caused by the false narrative that the Fed will cut interest rates by 3 times. When this sentiment is proven wrong, and it's already proven wrong, guess what will happen to the June bottom? It's going to open up like a sinkhole. And if you think that the Fed is bluffing, I don't think they're bluffing right now. Look at what's going on to the increase in money supply. The inflation-adjusted U.S. money supply has actually turned negative. Does this indicate that the Fed is about to cut interest rates? And if that was not clear to you, listen to what Chairman Powell said back in the meeting, what was it, 2 weeks from now, on the conflict of the 2 mandates? Take a listen.
Restoring price stability is just something that we have to do. There isn't an option to fail to do that, because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
But as a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you've been getting, if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
Yeah, we're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions. When that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder, and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
What would you say to individuals or households who may yet lose their jobs in this tightening cycle in the fight against inflation as they try to translate what Fed policy means to them in this complicated economic landscape?
Yeah.
Thank you.
So I guess the first thing I would say to every household is that we know that inflation is too high. We understand how painful it is, particularly for people who are living paycheck to paycheck and spend most of that paycheck on necessities such as food and gas and heating their homes and clothing and things like that. We do understand that those people suffer the most. Middle class and better off people have some resources where they can absorb these things, but many people don't have those resources. So, it is our job, it is our institutional role. We are assigned uniquely and unconditionally the obligation of providing price stability to the American people, and we're going to use our tools to do that.
So to simplify what he actually said, he doesn't really care as much as he used to in the first mandate, which is employment, meaning if unemployment rises higher, that's not going to make the Fed blink on the second mandate of price stability. Meaning right now, the commitment is not on full employment. The commitment is in tackling inflation down, even if it means higher unemployment for a little while. Because Powell says you cannot have a stable jobs market without having price stability. Well, guess what happened on Friday? The employment report was not weak at all. The employment report was hot, and that gives Powell more than the room he needs to tackle inflation down. It gives Powell the room not just to do another 75 basis points hike. It gives him the room to do what I prefer, which is 200 basis points in a single meeting, the Volcker style, because that shock and awe approach, psychologically speaking, will take inflation out of the picture. But regardless of that, the Friday jobs number indicates that the Fed will go strong, that the Fed will go even more aggressive. And the confirmation for that, by the way, the nail in the coffin for the dip buyers who've been buying since June would be if the CPI this week comes out hot. I'm not talking about headline inflation. I'm talking about core CPI. If that comes out sticky, not going down by much, or even worse, actually moving higher month over month, that would be a disaster for the bulls, a disaster for the sheepies, a disaster for the pumpers, a disaster for the pivot crowd, a disaster for the soft landing crowd, because the Fed will have to do the 100 basis points in September. With that, folks, let's move on to cover the stock market, and we start with the closing of the indices last week. And here we go. On Friday, the Dow Industrial Average was in the green by 76.65 points, or a gain of 0.23%. The Nasdaq was down, losing 63.03 points, or a decline of a half a percentage point. The S&P 500 down by 6.75 points, or a decline of 0.16%. The sector's performances on Friday were led by energy, materials, and financials, while the laggards were led by cyclicals, communication services, and utilities. Let's contrast this with the performance for the week, leading the pack at number 1, capturing the gold medal, technology. Number 2 for the silver, communication services, and number 3 for the bronze, cyclicals. Meanwhile, the laggard for the week was energy, down big time. The advance to decline ratios on Friday, NYSE 55% advancing versus 41% declining. The Nasdaq 56% advancing versus 38% declining. Moving on to commodities, crude was actually higher initially in the day, but it settled pretty much in the flat line, and this week will be highly critical for crude because we have critical support. If that support is broken, we're going to see a free fall in crude oil prices. Yet we have the gasoline RBOB, which gained about 2% on Friday. On the other hand, heating oil was down by about 4%, while natural gas with a modest decline of about 1.5%. Softs, on the other hand, the crash in lumber goes on, down another 5% on Friday, along with coffee down a similar amount, while cocoa futures down modestly, losing about half a percentage point on Friday. On the other hand, we have gains led by sugar futures, which scored gains of about 2.25%, and then we have OJ. The run in OJ continues to go on, scoring gains of about 1.5%. Likewise, cotton futures, the similar gain. Metals, mixed picture across the board. The precious metals, gold and silver, were down on Friday, while the cyclical indicators, platinum, copper, palladium, were actually higher. You got decent gains of about 2.5% for palladium, and really decent gains for copper, up about 2%. Copper is absolutely hammered and broken so far, so it is due for a pop, and perhaps this is it. The problem is, if the dollar goes higher again, it's really hard to see copper continuing to score more gains. What about meats? Muted action on Friday, but all of them in the green, the ones that we cover at least, live, feeder cattle futures, lean hogs, all in the green. Then we have grains. The decliners were led by soybean meal futures, down a little over 3.25%. Likewise, wheat losing some ground for about 1% or so on Friday. On the other hand, soybeans futures pretty much muted for the day, flat line. Yet we have gains, and the gains were led by oats, a big rebound in oats, scoring gains of a little over 3.25%. Likewise, soybean oil, scoring gains of about 3.5%. We saw green activities in corn, canola, rough rice futures, modest gains, but they count. Moving on to the big casino, the options market. What's going on here? What took place on Friday? The hottest table by far was the Tesla table, with about 2.5 million contracts traded that day. About 56% of those were calls. Now, Tesla was down big, over 6.5% on Friday. I have a theory on why, because I got some bad news. We'll cover that in the heat map analysis, but I did not listen to Elon Musk and the shareholder conference, whatever it is. So if you happen to be a Tesla culty and you know why, what he actually said to upset the stock, let me know in the comments. The second hottest table was AMC, a gamma squeeze in AMC, with about 1.3 million contracts. About 71% of those were calls. I'm going to cover AMC perhaps in tomorrow's video, assuming the gamma squeeze continues, because we're seeing an interesting phenomenon in buying upside calls, which triggered the gamma squeeze. The continuation of buying upside out of the money call options will ensure that this gamma squeeze continues, but if the bettors stop buying call options out of the money, guess what will happen? The market maker will dump stock, and we will see the gamma squeeze ending. We'll talk about that in details in tomorrow's video. But for now, number 3, we have Apple at around 1.1 million contracts traded on Friday. About 51.5% of those were calls. What about the unusual activities that took place on Friday? You might notice that the traders are betting for the short term. They're not really sure after Friday's employment report. They're not really sure what's going to happen. So they're betting with 7 days till expiration, or for the longer expiration, they're taking shots way out of the money, a few cents here, a few cents there, nothing serious at all. And this is an indicator of uncertainty and the lack of conviction in these bets. But we have the ticker TSLA, Tesla. Somebody's betting for a rebound. The action that we got on Friday is just maybe a mere disappointment of Elon Musk's commentary, or maybe the ruling with Twitter and the chaos that's going there. Who knows? I have my theory. We'll talk in the heat map analysis, but somebody's betting for a rebound. They bought the 910 calls for the expiration date, August 12, meaning this upcoming Friday, with expectations that the souffle will rebound higher and score gains of about 5% or so. And they paid around $9 a piece to enter this trade, all in all spending around $9 million. And then we have the ticker UPST for Upstart's holding. Massive rally as of late, but somebody's fading the rip buying the 26 puts, the expiration date, August 12, with expectations that the name will move down and lose about 12% of its value by then. They paid around $2.50 a piece to enter this trade, all in all spending around $2.5 million. And by the way, I did follow this trade for UPST. And lastly, what about the ticker AMC for, you guessed it, AMC? Somebody's fading the rip that we got on Friday on the APE token, or the ticker APE, get free shares, which actually dilutes the value of the company. But for now, who cares, right? Put your blindfolds on. Well, somebody's fading the rip here by buying the $20 puts for the expiration date, August 12, with expectations that AMC will lose about 10% of its value by then. They paid around $1 a piece to enter this trade, all in all spending around $1 million. Next, moving on to the heat map analysis. What's going on here? Here's the heat map for Friday's action. As you can see, muted across the board, we saw a rebound in the losers for the week: energy, materials, banks rebounded higher, perhaps on expectations that the Fed will indeed tighten the monetary policy even further. And we're seeing some money coming out of the big caps, technology, the riskier assets, the winners for the week. Why? Because the market is now thinking, wait a minute here, maybe we went ahead of ourselves in the pivot assumption, but we're not seeing conviction yet. We're not seeing severe outdraws and profit taking from the big caps, from chips, from software, from the risk-on segments. We're seeing some, but not enough. The losers, we're seeing severe drop in Alibaba, down about 5% on Friday. Tesla, we talked about that, but we don't have a theme here. I think the market will think about it and will give us the real reaction this upcoming week. But it all depends on the CPI. If the CPI comes out really weak, you're going to see a blast in the big caps, software, the riskier assets. But if I'm right, and we see the headline down, but the core sticking or even moving higher, it's going to be a problem. We're going to see profit taking. The big caps, software, chips, cyclicals will all go down. Now, on the other hand, will we see a revival of the inflationary trade, meaning the materials, the fertilizers, oil, gas? It's too early to say that. We saw some signs on Friday, but we don't have a confirmation yet. Now, let's contrast all of this with the performance for the week. As you can see, it's the opposite picture. Although the weakness in big pharma sticks because we have some disappointing earnings. They're not really disappointing, but these names ran really high year to date, so we're seeing some profit taking here. But the obvious loser is energy. Energy down big for the week. We're seeing weakness in names such as Caterpillar in industrials. We're seeing weakness in Walmart. We talked about that, the layoffs and the profit margins shrinking. But the majority of the money flew out of the energy, materials, big pharma, defensives into what? Into chips, into software, into the communication services, the cyclicals, the Amazons of the world, the big caps, the biotechs. In other words, the market was assuming, at least until Friday, that it should go risk on because the Fed will indeed pivot and start cutting rates. We now know this assumption is wrong. We're waiting for the confirmation in the CPI. In the meantime, here's some corporate news for you. When we start with Tesla, we talked about the souffle. Let's talk about it here. The good news is the so-called Inflation Reduction Act, which is absolute bullshit. But the good news for the souffle is they're going to get more government subsidies, more government handouts in the form of tax credits. So if you want to buy a Tesla, you're going to get a tax credit for about $4,000. That's in the used vehicle, and you're going to get about $7,000 on a new vehicle. So this is good news for Tesla. The problem is it doesn't reduce inflation because there is aggregate demand. If the prices of Tesla go down due to tax credits, you're going to see more demand, and Tesla will have no other choice but to increase prices higher. Net, the prices will actually go higher because the demand is kicking in once again. Thank you for the tax credits by the government. Another piece of good news is Reverend Elon Musk saying that Tesla will continue to do very well even if he was kidnapped by aliens or went back to his home planet. And rumor has it his home planet is called Shkaputu, which in Estonian means the planet of the assholes. But here's the bad news for the souffle. Number one, we're getting multiple crashes with souffles hitting motorcycles. And now the regulators are coming to the conclusion that the souffle doesn't really count motorcycles in the full self-driving mode. And to add more to the misery, remember, California was so generous to Tesla, we gave Elon Musk the Fremont factory for pennies on the dollar. It was a gift from Californians, and without it, Tesla would have never been possible. As a thank you, of course, Elon Musk abandoned California, and he went to Texas. And now California is looking for revenge. Here's how they're going to get the revenge. California regulators aim to revoke Tesla's ability to sell cars in the state over the company's marketing of its full self-driving technology. Now, are they going to go that far by banning Tesla? I doubt it, but it's certainly bad news, and it's a cloud hanging on the stock. Next, we have bad news for Discovery. I used to be bullish in the stock last year, not after they bought CNN. CNN is toxic garbage, toxic waste, and it's crashing the entire stock. But we have more bad news. The movie Bad Girl is now canceled. You're not going to see it. Not on streaming, not in the movie theaters. They're done with it. Why? Because the CEO says it sucks. It's bad. It's so bad. We're so embarrassed to even release the movie. And this is creating a controversy. Why let Batman go out, but not Batgirl? You sexist, Warner Brother, Discovery, whatever your name is. Number 2, the star lead happen to be, what is she, Dominican? And now they're saying, okay, you're racist against Latinos or whatever. Bad PR for the company. I don't want to engage in that kind of fight. Settle it. Make sure that the critics are happy. Or why you canceled Batgirl. And then we're talking. And then we have a really horrific report against the iMob of Apple. You know, the iMob, they got the virtue signaling. They want to lecture us on how to be woke enough, yada, yada, yada. But when it comes to their own practices, they're absolute pigs. For example, take a listen to this story. The report says Apple retaliated against women who complained about misconduct in the company. Uh-oh. And I'm not going to read the story for you because it's too graphic, but you can read it for yourself. This is the same company that shames all of us that we're not woke enough. We're not diverse enough. We're sexist. We're a bunch of pigs. Meanwhile, amidst all of these reports, they ignored all of these women. Horrific allegations. And Apple did nothing. They actually dismissed them. Please read the story for yourself. I cannot read it here because the channel will get censored. But here's another bad news from the iMob. We know that they're cheerleaders for China. They're apologists for the CCP. Nothing new here. And amidst the tensions between the US and China due to the Pelosi visit, Apple reportedly warns suppliers not to use made in Taiwan labels on products to avoid angering China. So here's Apple once again appeasing China. And we're now hearing rumors that the next iPhone 14 will actually be delayed due to the problems with China. So unfortunately for the iPhone cheapies, you're going to wait a little longer to get your new color, vibrant orange, aqua blue, because that's the kind of innovation that the iMob is doing so far in the iPhone. Next, let's go to the heat map for the ETFs for the week. What's going on here? Muted, but we're seeing some action in the cyclicals, technology, chips, the SOXL, XLK, all in the green, but most importantly, the cyclical sides /risk on. Not all of them, but the XRT retail was higher. XBY, check out Biotech, the winner for the week, scoring gains of about 14%. But besides that, believe it or not, from an ETF perspective, regardless of the run in the big caps, the ETFs were actually muted. No action at all. Slightly to the downside. When we look at internationals, for example, they're down across the board, with the exception of the EWZ. Commodities down big, but only certain pockets that really lifted the market. What does that say? It says that we're seeing buying of the big caps, and the big caps did the heavy lifting in moving the NASDAQ and the SPY higher. Once the big caps get shot again, the rebound rally goes bust. Next, moving on to charts, and we start with the SPY, the S&P 500, 30-minute chart. What's going on here? The answer is nothing is going on. Still within range, the support 410, the resistance 416, nothing happened at all, technically speaking, of course. But the psychology tells a different story. For example, we got a gap down. Good news means bad news. We got a hot employment report. The assumption is we should have seen a bigger drop in the indices. But the fact that the chart kept 410 as support, and we saw the dip buyers showing up once again, that tells me that the psychology remains bullish. The sentiment remains bullish. There is a healthy dose of skepticism among the bulls, the market participants in general, about the Fed's resolve that they're going to follow up and indeed increase interest rates further in September. What does that mean? It means the market participants are willing to look through the employment report that we got on Friday and blast the chart higher even above 416. But they're going to be hesitant to do that because there is another reality check coming in the CPI. What if they go ahead of themselves and blast the chart above 416 and then they get trapped after the CPI and we see a massive gap down? And therefore, my assumption for now is we're going to see muted trading all the way till Wednesday. And I'm watching out for the support lines. I'm watching out for 410. I'm watching out for 405. If the chart starts to break more support lines, that will tell us right away the pivot from the rebound rally, the bullish sentiment, back to the bearish sentiment once again. Here is the daily chart for the continuous contract of the SPY. Again, the chart is within the danger zone, the heavy resistance zone. It's not going to make it above this zone easily. It needs more than one catalyst. It needs the CPI to come out really, really weak. Other than that, I doubt that the chart will make it above 4,200 in one shot. If anything, we could see a pullback and even a loss of 4,100 as support. The CPI will do the job if it comes out way hotter than expectations. The bad news for the bulls right now is the volume moved higher slightly on Friday, and on top of that, the momentum indicators are becoming really overextended, meaning the risk is to the downside. If the CPI does not deliver, or if we have bad news coming out of China, you will see a flush down. It gets really risky right now despite the pattern. The candlestick pattern alone says that this is a bull flag consolidation, which will be broken to the upside. But when you put it in context with the fundamentals and the upcoming catalyst, it becomes really, really risky. And here is the SPX, a weekly chart for the cash index for the S&P 500. We have very strong resistance at around 4,100, and the chart is going back and forth for now, struggling in this resistance zone. Typically, technically speaking, when a chart gets to a heavy resistance zone and then it breaks above it, it produces a massive pop. And if that happens, it will be due to a weaker than average CPI, and then we will see a pop higher all the way till the resistance line, the sloping line of resistance that you see in yellow, and that will take the chart all the way at around 4,300. This is the bullish outlook. The bearish outlook says the chart is not going to make it above the resistance at around 4,100, and then the CPI will be the nail in the coffin. We will see the chart moving down again. It's not going to make it above the resistance zone. What about the Qs? 30 minutes chart. Similar with SPY, nothing is going on here. Consolidation within range above the critical support at around 316.5. We saw the dip buyers showing up once again. Despite the hot employment report, the dip buyers showed up again. The psychology says the bulls are not dead. They're not deterred at all. They're going to continue to buy the dip over and over and over again until there is certainty that they're wrong in their assumptions of the Fed pivoting. The CPI will seal that deal. For now, I'm eyeing the support of 316.5. That's broken. We have 313. What about the resistance, you might ask? There is not a lot of resistance from this point on. So if there is a legitimate catalyst, meaning the CPI comes out really weak, we could see a blast here. But we'll take it one step at a time because that assumption will not happen until we have a weaker CPI. The bears would argue, hold on your horses here, because what we're seeing is a bear flag consolidation, which will make the chart break 316.5 for good, and then the chart goes on at 313. The CPI comes out, turns out core CPI is not moving, it's still hot. The Fed needs to do a lot more. And what do you know? The chart breaks 313 as support once and for all, and that creates a free fall all the way down to 297.5 at a minimum. So big move coming, one way or the other. The CPI will seal the deal. Here's the daily chart for the continuous contract for the Qs. The bulls would argue we're seeing more consolidation, bullish consolidation, a bull flag pattern at around 13,300. Sooner or later, the chart will break above that. They might go all the way till the next resistance at around 13,600, or even better, the trend line that you see in yellow. The bears would argue the volume went higher on Friday. On top of that, the momentum indicators are really overextended, meaning the risk is to the downside. Any disappointment from whatever source, China, CPI, earnings, Fed commentary, could produce a flush down, but the bears are not going to be emboldened until we see 12,766 broken as support. And even after that happens, the bulls are not going to capitulate until we see a pattern of a lower low. For now, this recent pattern is showing higher lows. Until we see a lower low, the pattern is not broken. And here's the IWM, the Russell 2000, 30 minutes chart. We got a break below the trend line, and the chart briefly lost 188 as support, but the dip buyers showed up again. They closed the day above 188, not only that, but above the trend line once again. This is a bullish pattern, but the thinking will happen over the weekend. We will see the true reaction to the employment report next week. The resistance for now is 191.5. I wouldn't feel too comfortable if the chart breaks above 191.5 before the CPI. For me, it would actually say the risk versus reward says the IWM will go down after the CPI. For now, until we have a break, one way or the other, breaking the support of 188 or the resistance of 191.5, we don't have a clear sense of direction at all. The chart remains within range. But this is the most important chart. It's the dollar index. The dollar moved higher on Friday. We're seeing the momentum indicators improving, turning their way from bearish momentum to perhaps upcoming bullish momentum. And on top of that, when we zoom in to, let's say, a 2 hours chart, what do we see here? We see that the sloping line of resistance, the declining trend, the bearish trend, whatever you want to call it, doesn't matter to me, has been broken once and for all. We got a false breakout before, but now we have a higher low, and we have a legitimate breakout that is forming a bull flag pattern, which means the dollar should be blasting higher this upcoming week. The CPI will confirm that the dollar should move higher if it comes out hot or sticky from a core perspective. What does that mean for gold? It means that I'm not trusting the pop higher in gold. At least not for now, until the CPI is out of the way. The assumption is if the dollar moves higher, gold will lose 1,763 as support. So for now, I'm looking at it, not doing anything about it. Even though we have charts that suggest the gold miners are really undervalued. Look at the gap between gold, the price of gold, the commodity, versus the discount in gold miners. So a lot of folks are saying, wait a minute here, maybe we should go and buy gold miners really cheap. So far, it has been proven to be a bull trap. Gold miners continue to go down, even though gold prices did not go down by a lot. Why? Because the cost, inflation, is killing the gold miners. So I'm not going to buy the dip here in gold miners until I see gold moving higher and the dollar finally giving up. And this has not happened, not yet at least. What about a 4-hour chart for crude Brent? What's going on here? We have a critical support at around 94.5. If that's broken, we're going to see a free fall in Brent because the next support happens to be in the 80s, at around 86. So this week is really important for oil bulls because if these charts don't rebound soon enough, we will see a crack below important and critical support lines, not just in Brent, but also in the WTI. Next, we have the 10-year yield, the daily chart. What's going on here? The bull flag pattern consolidating beneath 272 played out, and now we have a pop. 2.72 becomes support, and then we have the resistance at around 3%. The momentum indicators are improving, indicating this chart should be moving higher. If it does, remember, the June bottom in the NASDAQ happened because we have a June top in this chart. Now, if this chart pops higher again, what excuse would the NASDAQ bulls have to continue the rally and the rebound higher? Not a lot. Here's the TLT, a weekly chart. What's going on here? If the assumption is that the 10-year will move higher, then the run, the rebound, the short covering in the TLT is over, and it should go down all the way to 109.5. But hold your horses, everything could change in the aftermath of the CPI. It's a long shot, but what if the CPI comes out cooked, meaning they show us that core inflation is down big, and the TLT will rebound, and the 10-year will go down, the dollar will go down, and we will have a blast in the stock market. Even though it is a remote possibility, it could happen. What about the VIX 4-hour chart? What's going on here? The bad news is, good news for market bulls, SPY bulls. The chart lost the important critical support of 21.53. We're having negative momentum, bearish momentum in the MACD indicator. The next stop would be at around 20. But why do I have the feeling that the VIX will rebound before 20? It is just a feeling. It's not supported by any facts or technical indicators at all. Matter of fact, we have the viewer here sharing the daily chart that we have an important critical trend line. Well, guess what happened to that trend line on Friday? It got broken. So this chart actually supports the VIX going down to 20, if not below that. We'll see what happens after the CPI. What about the VXN, the VIX for the NASDAQ? No conclusion here at all. It is still holding at the critical support of 27.5, but from a MACD perspective, we're not seeing a decisive conclusion one way or the other. The indicator keeps going back and forth, and until we see a definitive conclusion in the MACD, I'm not ready to say whether the VXN will pop higher or crash down, and therefore the uncertainty in the NASDAQ. But here's Apple, a daily chart. What's going on here? It is getting severely overextended on the RSI, the MACD indicators. My bet is the chart will go down to close the gap at around 157, and I'm putting my money where my mouth is. I have puts on Apple. The bad news from China, the pivot assumption being proven wrong, all of these are catalysts for Apple to go down. And sooner or later, we will see profit taking at least from this massive run higher from all the way down at around 130. Now we see the chart at around 165. Sooner or later, we will see profit taking. So the risk versus reward says Apple will go down to close the gap. Now, what about the souffle, Tesla, 30 minutes chart? What's going on here? The chart could not make it above 935. That was tough resistance, and we talked about that. This would be a signal to short. And the chart formed the bear flag pattern. That played out on Friday. We got a gap down, and unlike Apple, the Qs, and other charts that we cover, we did not see dip buying here. We saw more selling throughout the day, and the chart closed at the lows of the day. It lost critical supports around 886 and 866. On the other hand, the momentum indicators, in this case the RSI, is severely oversold, meaning if this happens, if we see an oversold bounce, the chart makes it above 866, but it gets all the way to 886, and it doesn't make it, it gets rejected, and it loses the next support at around 866. That would be a shorting signal, a very strong shorting signal. Now, what about the bullish scenario? The bullish scenario says we get an oversold bounce, the chart makes it above 886, it goes down in a retest of 886, and then it rebounds higher. If that is the case, then Tesla will make it all the way in a retest of 935. So keep these scenarios in mind and trade accordingly. Lastly, what about Bitcoin? What's going on here? A 2 hours chart. We got the false breakout, but we did not get the visit to 22,000. Revisit, I should say. What we got instead is consolidation, where the chart is consolidating within a range. What does that mean? The chart says, I want to give it another shot if we have any buyers. Any buyers on the sidelines, we can go higher here. If the buyers don't show up, then we see a drop all the way to 22,000. But for now, the chart feels that it got the energy and the buyers on the sidelines to pop higher again. When we look at the weekly chart of Bitcoin, we have a critical support, 20,000. We all know that. We have critical resistance at around 29,000. If we have a pop and a rally in the summer, whatever left of the summer, look at the MACD indicator, look at the RSI. They're both oversold, but they're turning corners. The momentum from a MACD perspective, at least on the weekly chart, appears to be bottoming from a bearish perspective and about to create new bullish momentum. If that is the case, we could see a run all the way to 29,000, but here's the problem. The monthly chart says that the bearish momentum is not over yet. If we don't see a pop, a significant one, soon enough, the chart will crack below 20,000 and it will go all the way down to the same trend line it diverted from, and that trend line will be at around 8,000. So the monthly chart says the pain is not over. The weekly chart is more hopeful than that. But bear in mind, we could see the weekly chart playing out. We could see a rally in Bitcoin all the way to 29,000. And that would not erase the bearish outlook on the monthly chart, so long as the pop stops at 29,000. So in the short run, Bitcoin, technically speaking, looks to be bullish, looks to be turning the corner from being bearish to bullish. Monthly perspective, not so fast. But again, folks, we have to wait for the CPI. It is a critical report, not because we thought about it before as being critical. We knew the headline inflation will be down, but it became really critical on Friday because we got a hotter than expected employment report. And that made the upcoming CPI really important because either it's going to come as a confirmation of the employment report that inflation is not dead in the economy, not even close, or it's going to come as a confirmation to the soft landing crowd that they got a hot employment report and a really weak inflation report. And that confirms the Fed pivot, an important battle between the bulls and the bears coming this week. It should be settled once and for all. And with that, let's move on to the conclusion of this video. What do we have on the economic calendar this week? On Monday, we have the New York Fed 3-year inflation expectations. On Tuesday, the 9th, we have the Small Business Index, we have productivity, and unit labor cost. This will be critically important. Wednesday, the most important day, we have the CPI, aka the CPLI, and everybody will be talking about that and nothing else. And then we have Thursday, the 11th, we have initial jobless claims and the PPI. And lastly, on Friday, August 12th, we have the Import Price Index. On top of that, we have the University of Michigan Consumer Sentiment Index. With that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.
Remember I told you when you started, the guys who last in this business are the guys who fly straight, low-key, quiet. The guys who want it all. Chicas, champagne, flash. They don't last.